Populism hits the financial markets. Is it a fluke, or does it point to something deeper? This is Bloomberg Wall Street Week. I'm David Westin. This week, special contributor Larry Summers of Harvard.
Yes, there is retail fraud. Not everything that's done by short sellers is especially attractive.
Bank of America CEO Brian Moynihan.
It's good people are investing. I think people have to be careful, and we all know that.
Sharmin Mossavar-Rahmani of Goldman Sachs.
It is clear that this is not necessarily justified from a valuation perspective.
Jared Bernstein of the Council of Economic Advisors. Related Companies CEO Jeff Blau. And Peter Atwater of Financial Insyghts. There was a lot going on this week. The Federal Reserve had its first meeting of the new year.
The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved.
President Biden issued a new series of executive orders. Janet Yellen was sworn in as the first woman to be the U.S. Treasury Secretary. And, oh yes, the titans of tech announced their earnings from last quarter. But despite all of the major news, global Wall Street was consumed with the story of what had been a small, largely overlooked company that sold video games at the local mall. A company that the big hedge funds were happy to bet against, until a flash mob on the social media site Reddit decided to take on the shorts. And the rest is history.
This has captured the attention of the America and every trader and non-trader alike.
The word nuttiness comes to mind, to be honest.
The GameStop story is good fun to watch, a sort of financial porn. But we need to ask ourselves whether there's more to it than just a battle of the netizens versus the shorts. Whether a combination of the liquidity in the market, driven by the Fed, put together with the phenomenon of social media, with just a pinch of lingering resentment of a financial system that seems to be rigged, is part of a larger truth. Something that could point to an ugly reckoning around the corner with historically loose monetary and fiscal policy.
It's really been the printing of money by the central bank and the distribution by the government that's financed a lot of the activity.
Here to help us make some sense out of these markets and how they're reacting to the news of the week is Sharmin Mossavar-Rahmani. She is Chief Investment Officer at Goldman Sachs Wealth Management. Sharmin, always a pleasure to have you on. We had a fair amount of up and down in the equity markets this week. On Wednesday, they were down the most since October. And you can tell us why that is, maybe because of what we heard out of Jay Powell, the Fed chair. And then on Thursday, they came roaring back again. What do we make out of all this? Is it telling us anything more fundamental about the economy?
First of all, thank you for having me. I always enjoy being on your show as well. In terms of the specifics of this type of volatility, if you think about the equity markets, on average, the volatility is around 15. Now, since the pandemic, we've been above 20 for a long period of time. So seeing this type of market moves is inevitable. In fact, if we go back and look at the post-global financial crisis period, we have had episodes of the market down 5%. At least 95% of the time. Episodes of down 10%, 75% of the time. So one has to look at this kind of market move and recognize that this is just a lot of noise. The main signal and the main message that we're giving our clients is to stay invested. We have good economic growth. We have a very, very favorable earnings outlook. And so when you combine all of those, our recommendation continues to be stay invested and look beyond this kind of volatility at this time.
As you know, we heard from Chair Powell this week, and he was asked about the question of bubble or froth or sort of extended valuations because of the very accommodative monetary policy. He sort of dismissed that, I think it's fair to say. He didn't think that's the real problem here. Do you have any concern about that at all? Because there's a lot of talk around right now about things being overextended.
When we look at equity valuations, there are a couple of different perspectives we bring to bear. First and foremost, we look at a series of metrics, but we look at them not just compared to long-term averages, but one actually has to look at them in the context of a period of low and stable inflation. So when you're looking at the environment we have been in since April of 1996, which is low and stable inflation, we actually are not as expensive as people think we are. In fact, based on looking at the broad range of these metrics, our view is that given a view on where we're going to be on earnings this year, we're probably about 14 to 20% overvalued. That is not a bubble. In addition, we actually look at equity risk premium. What are equities yielding relative to what bonds are yielding? That is also above average. And finally, we actually have something we called, it's an indicator that looks at explosive price behavior. And we have to get that to around 90 to 100 to think we're in a bubble. That currently stands at 26%. It's at 100% for Bitcoin, but for something like equities, it is not showing bubble levels at all. Furthermore, if we compare it to where we were in the dot-com bubble levels, we're substantially below that. So definitely not a bubble trouble yet from our perspective.
Sharmin, a moment ago you referred to explosive growth. We cannot talk about explosive growth this week without talking about GameStop. I mean, you just have to talk about it. Give us your take on GameStop. What is going on there? Is that a fluke? Is it a symptom of something else? What's driving that?
When we look at these types of headlines and this kind of price action, it is clear that this is not necessarily justified from a valuation perspective. So what is it driving it? In an era of social media, easy access to trading, very low cost in terms of transaction costs for people, you can have a lot of momentum and a lot of investors can pile into an investment theme. And that does mean that you're going to end up with prices that don't probably reflect fair value. And this could be seen in many areas. It's not just individually in a particular stock. You could see it in other sectors and asset classes. And again, cryptocurrencies are a good example where you see the same type of price action, where it's not clear these are justified by any value argument and any fundamental arguments.
Yeah, I don't hear anybody arguing that it was justified by value arguments. Does it pose anything of a risk for the rest of the market?
In terms of the price action, it'll get some attention, it'll get a lot of headlines, but at the end of the day, again, one has to separate all this noise from the main signal. It's not as if we would recommend our clients have a significant allocation to any of these sectors or specific stocks. Core assets really need to be in something like the S&P 500, in something like IFA, very small allocation, for example, to emerging markets, but it needs to be more diversified. One of the pillars of our investment philosophy is the real way to create good long-term wealth is through having some diversification in the portfolio.
Okay, Sharmin, as I say, it's always a great pleasure to have you with us. That's Sharmin Mossavar-Rahmani of Goldman Sachs. Coming up, what caused the GameStop spectacle and what should be done about it? From Peter Atwater of Financial Insyghts.
What we're seeing today is very aimed at going after companies that everybody was convinced were on their way out in a stretcher.
This is Wall Street Week on Bloomberg. A video game store is at the heart of a titanic struggle between short sellers and retail investors. Until recently, GameStop was a company whose time seemed to have passed, with serious gamers turning to the internet, not the mall, to get their games. But then social media got involved, starting a meteoric rise in GameStop stock after Reddit's Wall Street Bets forum started pumping the stock to its users. The army of social media-empowered day traders catapulted the former small caps market value beyond those of even members of the S&P 500.
It just reflects the liquidity that exists and the new players in the markets. Historically, it's indicative of a bubble type environment, but it could go for a long time.
The amateur day traders were targeting short positions held by Gabe Plotkin's Melvin Capital and Andrew Left's Citron Research. Hedge fund titans Ken Griffin and Steve Cohen injected a total of $2.75 billion into Melvin Capital amid the short squeeze distress.
What's happening is that the retail right now is stronger, but the short bets come back and fill in. So it's just a battle that's going to continue. You're going to see GameStop go way higher.
Within a matter of days, the Reddit army had pushed the rally so high that Melvin Capital and Citron threw in the towel on their short positions.
Citron Research will no longer be publishing what can be considered as short-selling reports.
The Reddit army of day traders also boosted other has-beens, including BlackBerry, Retailer Express, and AMC, which is fighting to stave off bankruptcy. Hedge funds are now on the hunt for other companies that could end up on the Reddit mob's radar.
I think you're going to see a number of hedge funds declare bankruptcy in the next several days.
Online brokerages reported service disruptions caused by the retail trading frenzy, and a number of them, including Robinhood, took the rare step of limiting some transactions on shares of GameStop, AMC, and others.
You're witnessing the French Revolution of finance, where the proletariat is rising up to change the order structure in finance.
There's been a surge in overall retail trading activity as people stuck at home tried their hands at trading. According to Bloomberg Intelligence, individual investors accounted for almost 20% of the trading volume in 2020.
The fact that retail investors are going to be able to communicate with one another, that they can actually consolidate their buying power, is something I don't think the regulators would have anticipated even 3 years ago.
So what caused the perfect storm that some call GameStop? We asked Peter Atwater, president of Financial Insyghts, and he said it was something that had been in the works for some time.
What we've seen over the past couple of years have been these flash mobs with money, as I call them, where investors, particularly using social media, get together and aim at a single company. You saw this with Tilray, Beyond Meat, just one after the other. And what we've started to see is they move from moving shares to buying options to now buying options and things that are most shorted. And to me, this just reflects on the confidence of the crowd. They've gotten much more strident, much more aggressive, and honestly, they've succeeded at it. So behaviorally, this looks very, very predictable, and it's coming to a head.
Let's talk about regulation, because there's various discussion about whether the SEC or someone else should be getting involved. Does this potentially lie afoul of what's going on with the SEC in terms of existing regulation?
I don't know if it runs afoul or not, but as a researcher, I have found that regulators, when they act, react to sentiment. And so I expect that if sentiment becomes too extreme, people become concerned about systemic safety, then you'll see the regulators move in force. And that's what they do. They will close the barn doors at the moment that the animals have already left. They're going to pour water on a fire that was already extinguishing on its own.
Those who defend short selling say this is a way of really communicating information in an early stage, at least questions about a company. It really facilitates an effective market functioning. Does this get in the way of that, or is this just that same market signaling on steroids, as it were?
Yeah, I'm in the camp that this is signaling on steroids. I mean, what you have right now is absolute speculation using enormous leverage, targeted where they believe it will be most effective. And I step back and say that only happens, David, near the climax of a confidence cycle, where people are so certain that they're going to win that they bet the ranch in things that have enormous leverage. This is flipping houses, from 2005 on steroids in 2021.
Well, that's one of my questions, actually, because you are a researcher. Looking back through history, whether it's the housing bubble or going back further than that to tulips and South Sea and things like that, are there analogies that would inform us now, that might inform where we're going, or is this a one-off?
No, I think that the analogies hold. These tend to be climatic events where the crowd is enormous. It's moving in a manic, very frequent way. I mean, to me, it's less of a bubble than it's a series of one craze right after the other. And those high energy moments tend to happen, just at the peak in the confidence cycle.
Peter, we can't get in the minds of the people who are participating, particularly on Reddit here. But from your research, from your reporting, is this about finance as a base, or is it actually about politics or about social norms and a real resistance to sort of some of the institutions we've had, including going all the way back to 2008, and sort of a resentment about the fact that perhaps those in the financial system were not held properly to account?
I sort of look at the evolution of this paradigm, starting with sort of gamesmanship, people going online and using social media to make money almost as a game. Then it became very greed-filled. And now what you're seeing is, I think, a consequence of that K-shaped recovery that I've been talking about for the past year, where there is a jealousy, there's an anger, there's a frustration at the system. And I think the size of the crowd now encompasses that aspect. I mean, don't get me wrong, there's always a stridence to peaks in the market, but this has got anger behind it, and the behavior of the mob in many ways reminds me of what we saw 2 weeks ago at the Capitol. It's a mishmash of a whole lot of people.
Again, we're reaching for analogies because it's so unprecedented, but I also wonder if it has something to do in parallel with some of the cryptocurrency speculation, the extreme volatility there. And is it perhaps a generational issue?
You know, what started though was very futuristic. You know, Bitcoin, Tesla, EVs. It was very oriented towards possibility. What we're seeing today is very aimed at going after companies that everybody was convinced were on their way out in a stretcher. The retailers. These are companies that nobody was expecting to prosper, and the short interest just really has enabled the crowd to catalyze around them.
That was Peter Atwater, president of Financial Insyghts. Coming up, Bank of America CEO Brian Moynihan on the rise of retail investors and what it means for the markets.
It's already been pretty democratized. It's good people are investing. I think people have to be careful, and we all know that.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Brian Moynihan, during his time as chairman and CEO of Bank of America, has emphasized the strategy of responsible growth. What went on with GameStop this week seems like just the opposite of that, as some would say was the earlier parabolic increase in Bitcoin. But Brian says that it's not a problem with the democratization of finance. The forces are larger than that.
It's already been pretty democratized. Everybody talked about free trading. I think somewhere in like 2007 or something like that, I was riding around Manhattan on a double-decker bus with free trading on the side of it from Bank of America. This is not a new concept, and so we've seen 30% growth in our balances in our Merrill Edge, which is our more affluent segment. We've seen a net growth of 10%, I think, in what you call sort of digital brokerage accounts and stuff. And so it's good people are investing. I think people have to be careful, and we all know that. But I think if you look at it overall, if you look longer term, what are the themes in financial services? More and more digital. We're now up to 80% of our direct consumer loans done digitally, up from the start 3 years ago. More and more digital. More and more demand for, I want digital and I want high touch. I want the branches and I want the digital. More and more artificial intelligence applied, more and more operational excellence across all our platforms in terms of process engineering and taking out paper and putting in digital work. Those are the themes that are just going to be tremendous. Artificial intelligence, distributed networks, data information movement, all those things are incredibly important. But those themes have been with us. Now the question is we may have made a step change and we'll be after that. So yes, investors, yes, borrowers, yes, everything, but it's really the digital that's the new news, not as much as the underlying asset class.
When we talk about a lot of capital looking for a limited number of investments, it's not limited to ESG, goodness knows. We're seeing a lot of situations that some people think might be a bubble or at least froth or something. Are you concerned that, in fact, because of the liquidity that's been injected for good and sufficient reason to help the economy, that we really are risking ourselves in some places? I'll give you two examples. Bitcoin, goodness knows, has gone all over the place. And another GameStop right now that is really quite a phenomenon. And it's not the only one right now that's really getting bid way up. Should we be concerned that maybe this is an indication that maybe we're getting a little bit out over our skis?
Yeah, those issues at the moment happen at time, in the ebbs and flows in the market, and then, frankly, I don't have great insight as to those things. We've been clear about how we stand on Bitcoin and versus blockchain, which is a technology and stuff. But let me back up, and the question is, when you look at the economy, and it's about as big as it was in 2018. The projections from our team are for it to grow up 5% this year in 21. In 2018, in the second quarter, the economy was this big. It was projected to grow at like 1.5 to 2%. And the interest rate environment was 100 to 150 basis points higher. And there wasn't all this, so there wasn't interest rate accommodation, and there wasn't fiscal stimulus out there. Now you have the same thing. So the fiscal stimulus is needed to help people make it across the river here. You have 6% plus unemployment. You have these companies that haven't opened. That's the PPP program. You have holes in state budgets and that were created by the cost of paying for all this work, and maybe tax loss revenues and stuff. Those ought to be dealt with. And I think if we deal with that responsibly, then what happens? But the possibility of overshooting here is real, and that's what you're hearing. Less about the equity trading values at the moment, but more about the question when rates are at 1% and are going to stay there for a long time, it'll lead to risk, and that could lead to bubbles. But the real question that will be fundamentally bad for everybody is if we miss the inflation turn, and it's not there now. But that's one of the challenges that Chair Powell and his colleagues have is to really be watching this thing, and they need to make sure this great economy grows again at the right rate and above that right rate, and there's some inflation in order to make sure it doesn't go backwards. But on the other hand, it's going to be an interesting, as we move through the end of this year and the next year, when this has all come true, the vaccine's out and stuff, it'll be interesting to see how they play through that.
Well, exactly. Let's pursue that just for a moment, because there's been a lot of money given to a lot of people, again, for good and sufficient reason. They've needed it. But the indications are a lot of it's getting saved. It's not getting spent, in part because they don't have a place to spend it, frankly, because a lot of the economy is shut down. How concerned are you as you look at the economy, because you have a real vantage point into the economy broadly? How concerned are you that there might be a snapback that might actually trigger, believe it or not, inflation? We haven't talked about it in a long time.
Well, there's been, it's kind of interesting. If you trace last year, and we'll see with the fourth quarter, all ends up final. But if you think about down 30, up 30, and up a few percentage, 3 or 4 percentage points or whatever it turns out to be. And then this quarter, the projections are it may come down closer to flat, and that has a little bit to do with the first quarter. But if you actually then pull that apart and look at our consumer, what we call consumer spending, and so debit and credit card spending is one thing, but this is around, people taking money out of ATMs and spending it, writing checks for services, P2P, the Zelle product, which is huge right now. If you look at that spending through the first 23 days of January, it's up 8 or 9% over last year's first 23 days of January, which was up 9% over the year before. So it is bigger in dollar amount. It is growing faster than it grew from 18 to 19, and as fast as 19 to 20. If you look at the type of customer, obviously for the people who are unemployed and you can see them receiving unemployment benefits, they're using the money faster. If you look at the rest of the customers, they're using discretionary retail, not sustenance retail, so they're paying for their food because they're employed. And so I think these stimulus dollars can be spent much more precise, and I think the last case was a good one in that it went unemployment to the unemployment, some supplement there, the $600 under $75,000. Those are good items, and future stimulus ought to be likewise geared, because otherwise it gets diminishing returns. And then you have the issue of how you pay for it long term, and the issue of whether it creates inflation. But there's a lot of pent-up savings, and we would expect a good second half of the year. Now, it's just the mistake everybody makes is they get talking about all the economics and they forget there's one simple question, which is we have to win the war on the virus. And right now we're going in with a much better situation from the fight, in that we have this vaccine, and this vaccine's going into people's arms. And that then changes the course of this. And yet that's still out there, but that's a light at the end of the tunnel that wasn't here this year, last year in the summer.
That was Brian Moynihan, Chairman and CEO of Bank of America. Coming up, working from home once seemed to be the bold new innovation. But now for many, the question is, when can I come back to work?
People don't come back to the office. New York cannot recover. And that's really the sad thing that's happening now.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Wall Street has joined so many others in figuring out how to work from home efficiently and effectively. But the appreciation for all that added flexibility just may be wearing off.
It feels like it is fraying. It is hard. It takes a lot of inner strength.
It's remarkable that it's working as well as it is, but I don't think it's sustainable.
We have 10, 12% back. We weren't telling anybody to come back, but a lot of people want to come back.
Related Companies is the largest landlord in New York City and one of the most important real estate developers in the entire country. And we asked its CEO, Jeff Blau, what it's going to take to get people back into the office in New York.
The two obvious answers are vaccine rollout but probably even more critical right now is testing. We all thought after New Year's that everyone would return right back to the office, but in an interesting twist, I have a feeling that the vaccine announcement and the closeness of it has really enabled companies to just say, I'm gonna just wait. It's so close. I'm not gonna pull everyone back to the office yet. Unfortunately, in New York, office actual occupancy, people showing up at their desk every day, is under 10%. And it's critical that we kind of really push testing, make people feel safe and comfortable until they ultimately do get vaccines, so people come back to the office. If people don't come back to the office, New York cannot recover.
One of the things we're very conscious of in New York, obviously, are the financial organizations. Do you have a sense of companies in Wall Street, how eager they are to get their people back in?
I'd say it varies. I mean, I'm sure you've heard David Solomon really encouraging at Goldman to encourage his employees to get back. He had a very funny quote. He kind of said, well, sure, you guys all want to work home from your living room, and you can do that until your competitor shows up in person and wins an assignment. You guys need to get back to the office, right? So I do think that there is pressure. The market will ultimately bring pressure for people to come back. It's interesting. You hear a lot about tech tenants or CEOs saying, I'm going to let my employees just work from home till June or December or forever in some cases. And yet behind the scenes, when you talk to them, and I spend a lot of my time doing exactly that, really trying to understand what their plans are, they realize that this doesn't work from a long-term perspective. They realize that culture does not work. It is not created over Zoom, over Skype, or whatever we're using today. And interactions happen in the hallway, and you bump into each other. I know certainly here at Related, that's how we work. It's a little bit less formal, and our best meetings just occur when you walk down the hall and see somebody. And it's hard to create that on Zoom. You can't schedule that interaction. How do you train new people? You have an incoming class of analysts. Goldman has 2,500 new analysts come in, and what are they supposed to do on Zoom? So I ultimately do think, I think the long run answer here is that there will be more flexibility in the workplace. I think that employees value the ability to work from home a portion of the time. If you divide a person's day into the bump into a hall, an interactive meeting, and writing an investment memo, which they can do by themselves, maybe there's a way to divide that work up. And I'm just using this, the investment memo writing actually happens, on Friday at home. And the rest is, but it also needs to be a coordinated day.
In that world of more flexibility, as you call it, does that affect the long-term demand for commercial real estate as a practical matter? Are you looking at a different curve out in the out years?
I don't really think so, because ultimately you still need, for those days that you're coming in, people to have an office. What I think might happen is that the build out of space might change. So there might be more meeting rooms, more conference facilities, more auditoriums, and smaller, certainly private offices, and maybe more open cube type seating. So I think it's going to change. I don't think it will really affect the overall demand.
Are you seeing a shift in your own business between commercial on the one hand and residential on the other? And particularly when it comes to some of the big luxury malls, you have a really big one there at Hudson Yards. Are you shifting your use at that massive project down at Hudson Yards?
Yes. So we spent a lot of time thinking about the future of real estate development in response to the pandemic, but also just over time, everything evolves. And actually, if you think about Hudson Yards, it really had many of the features that we think are critical today. I mean, the words that people like to say today are 15-minute cities. Well, what does that really mean? It means that you want basically everything. You could work your whole day or spend your whole day within a 15-minute walk. So it goes back to kind of the live, work, play nature of the way we've been designing our mixed-use developments. So you think about Hudson Yards here, we have office, retail, residential. Retail, as you said, yes. Is there too much retail in many of these things today? Yes. And we are converting a former Neiman Marcus space into 420,000 square feet of incredible office space, because there is demand for office and less demand for retail.
That was Jeff Blau, CEO of Related Companies at the Bloomberg Year Ahead Summit. Coming up, the Biden administration takes on the battle with COVID and dealing with the economic consequences of it. We talked with Council of Economic Advisors member Jared Bernstein about what is needed.
This package is what it's going to take to finally put COVID-19 behind us.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. The Biden administration is hitting the ground running, but boy, does it have a lot of ground to cover. We talked with the longtime Biden advisor, just named to the Council of Economic Advisors, Jared Bernstein, about what it needs to get done.
The biggest problem is a dual problem, and you yourself, David, just nailed it, which is the dual impact of the persistence of the virus and its impact on economic activity, on commerce, on employment, on our ability to really get a recovery underway. And as I think you know, it's not an impact that is hitting everyone. When the president talks about a K-shaped recovery, he's talking about something real. When he talks about racial equity, he's also making a connection between who gets most hurt by these dynamics, these dual dynamics we're describing, and this legislative priority, top legislative priority of passing the American Rescue Plan. This package is what it's going to take to finally put COVID-19 behind us and get a bona fide recovery underway. It funds a national vaccine campaign to dramatically increase the pace of inoculations of vaccines. It mobilizes 100,000 public health workers. It ramps up testing, treatments, and therapeutics. It engages with emergency paid leave. It brings science back into the picture in a big way. It provides states and localities with the money they need to reopen schools, which is so important for kids and their parents and the economy. And I can say much more about its components, but that is the dual challenge we face, and this plan is designed to attack it and attack it hard.
And I must say, Jared, I don't hear many people, Republican or Democrat, complaining about trying to really attack the coronavirus, getting the vaccination program up, supporting public health, things like that. There are other issues, though, that people ask, is it really targeted? At that K aspect you just addressed, how do we make sure the dollars get to the people who need it the most? For example, on the $1,400 payments, anybody will say some people really need that desperately. Frankly, some people don't. They've kept their jobs. They're doing just fine.
Yeah, no, that's important. And I think the thing to recognize there is that the checks are better targeted than I think many folks realize. Now, that doesn't mean that they just go to folks at the bottom, but that's because it's not just folks at the bottom who need the money. And if anybody's listening to me in the 75, 100K range, many of them, yes, many have kept their jobs, many have lost hours, many have lost wages. Lots of those folks, and I'm not just talking about the poorest, I'm talking about folks in the middle class, something that's always been very important to President Biden. He talks a lot about the struggles that middle class families have had in recent decades. Many of those folks face issues around rent and mortgage payments. So there have been these moratorium in play, as you know, and that's allowed. But moratorium is not forbearance is not forgiveness. So at the end of these moratoria, people face very significant bills. Now that means that and this is really an important bit of economics here, because this gets down into some Keynesian multipliers. What we're talking about here is that yes, some of these expenditures will be initially saved and not spent. And that gives them kind of, a lower multiplier in a Keynesian sense. But that's just kind of a technocratic concern. I think what's most important is that we finally look ahead.
That was Jared Bernstein, member of President Biden's Council of Economic Advisors at the Bloomberg Year Ahead Summit. And now it's time for a look at the week ahead on Global Wall Street.
Thanks, David. The liquidity squeeze in China will remain front and center. Well, we'll be looking at the January readings on China's PMIs to get an idea of the economy's pulse. We also have central bank meetings in Australia and Thailand, with the RBA expected to maintain its $77 billion quantitative easing program. India's finance minister has a tough job on her hands to help spur a recovery in an economy facing its worst recession since 1952, when the country's budget is handed down on Monday. And Kuaishou Technology, the main rival to ByteDance in China, is slated to list in Hong Kong on Friday in what would be the world's biggest internet IPO since Uber. Danny.
Thanks, Juliet. In the EU, a dispute has opened up between them and AstraZeneca, with the EU saying that they need to fill their contractual obligation to deliver more vaccines, despite the fact there was a glitch in Belgian production. At the week ahead, we also have a BOE meeting to look forward to. What will the reaction from the BOE be, considering that data has significantly weakened in the UK? We'll see what type of stimulus they might propose or any other support measures. Romain?
Thanks, Danny. Well, U.S. investors will have a slew of corporate earnings to digest next week. More than a quarter of the 1,000 largest U.S. listed companies set to report earnings. Big tech will be in focus: Alibaba, Alphabet, and Amazon. And in the healthcare space, Pfizer, Amgen, and Regeneron will be ones to keep an eye on. Based on the companies reporting so far, the S&P 500 in aggregate has seen about a 1% drop in earnings per share, despite the fact that revenues are actually higher. Now, on the economic front, keep an eye out for manufacturing data on Monday, auto sales on Tuesday, and U.S. monthly employment numbers. That arrives on Friday, and it will be sure to bring back into focus that $2 trillion fiscal stimulus plan that President Joe Biden is trying to push through Congress. David?
Thanks to Juliet, Danny, and Romain. Coming up, we wrap up the week, as always, with special contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. We wrap up every week with our special contributor Larry Summers of Harvard. And this week we have to get Larry's thoughts on the phenomenon that is GameStop and what it may tell us about the state of our markets, our economy, and maybe our politics. More broadly, I should say. Larry, so thank you so much for being with us. You're a macroeconomist. You're not a day trader that I'm aware of. You're not a short seller that I'm aware of. So I'm not asking you about it as a trader, but from a macro perspective, is GameStop, let me put it simply, a fluke or a symptom?
I think it's a bit of both. I think it points up that there's a lot of activity in finance and in financial markets that's not necessarily particularly productive or particularly rational, and that there's a need for adult supervision sometimes. I don't think that this is something that's either going to lift the economy up or bring the American economy down, but it does seem like there's more risk than there has to be, born in a variety of directions.
So that's the question, really. Could this be a canary in the mine shaft? The economy's not going to make it or not make it based on GameStop, goodness knows. But it could be an indication, couldn't it, of sort of froth, or even more than froth, maybe a bubble. As you know, Chair Powell was asked about that this week.
Look, I think you've got to be concerned. GameStop is one thing. The ways in which IPOs have popped by a factor of 2 or 3, the new financing vehicles associated with some of what's happened in the SPAC sector, certainly not all of what's happened in the SPAC sector. All of this has a slight feeling of 2000 or 1929 in the air. And so I think the idea that we've got a new group of financial regulators coming in who are more committed to regulation than the previous group, I think that's all welcome. Whether that means that markets are in some aggregate sense overvalued, that's not a judgment that I'd be prepared to reach, certainly with confidence, but I certainly think risks are in a two-way direction. But I also think, David, that you got to look at both sides of this. Yes, there is retail froth. Not everything that's done by short sellers is especially attractive either. And certainly there have been excesses of the practice of short selling and then trying to disparage. And so there are things that have gone on in the hedge fund community that I think can at least be questioned as well. And in general, the activity of some people trying to short and other people trying to squeeze them, and people trying to create bandwagons to the downside. It's a pretty imperfect business, and I don't think anybody can feel entirely comfortable about what's there. I guess the other caution I'd want to put is not all well-intentioned regulation works out well. And, it turned out that in their early incarnations, certainly circuit breakers ended up exacerbating volatility because people started selling when they were afraid the market might close. In the incarnation that got put in, some of the rules we had on money market funds actually made runs on money market funds more likely, not less likely. So indignation and dismay about the status quo may be a necessary condition for new regulation, but it's not a sufficient condition for any kind of regulation. So I think we're going to need the people who are with regulatory responsibility to sit down, consult with all the parties, reflect very carefully on what's happened here and what its lessons are.
Larry, from your experience, having studied these things and lived through a fair number of them, where does this all lead? I mean, this week we had the likes of Alexandria Ocasio-Cortez join together with Ted Cruz, for goodness sakes, to agree there's got to be a congressional investigation. Where does Washington take something like this?
Look, I'd almost be prepared to say that whenever AOC and Ted Cruz agree, they're wrong. And that there's a general principle when a cause attracts the attention of both extremes, you have to worry a lot about that particular cause. And I think the idea that somehow the people who are involved in this are really great social justice warriors, and that this is an occasion to get the man, I don't think is a particularly fruitful way to think about policy. But my guess is that two things are going to happen. One is this thing's going to, in some ways, set in its own undoing. There are going to be some painful lessons learned. People are going to be more careful about shorting, because they got squeezed and routed on the one side. And people who are involved in pushing this stock up to ludicrous levels are probably going to end up losing a lot of money, and they're going to learn a lesson from that too. So to some extent, this thing is going to teach its own lessons. And I think the dull work of government, we're not going to have any instant legislation, but we're going to have committees formed to study various aspects of this, to make recommendations that are then considered, is actually going to probably lead us with better financial markets and a better set of rules than the rules we have today.
Okay, Larry, let's wrap up the week as we do every week with some Summer Says. 3 quick questions. Number 1, on the vaccination program, will it overperform or underperform what is now expected?
I think it's going to overperform. I think it was a masterpiece of spin, frankly, to define the objective as 100 million doses over 100 days at a time when even the Trump administration had figured out how to do 850,000 doses a day. So I think you're going to see that target massively outperformed on. My best guess would be you'll see 175 million doses in the first 100 days, and that's as it should be. And if we don't get a bad shock from biology, I think we're going to make more progress more quickly on COVID than many people expect.
What kind of progress are we going to see with the economy? Second question is, will we overperform or underperform current expectations for the U.S. economy?
Different people have different expectations, but I'm betting on growth above 6% this year. And I think that's overperforming on most people's expectations. I really think we very much now are in a world of two-sided risk. both in terms of real activity and in terms of possible inflation risk.
Third thing, Jay Powell, chairman of the Federal Reserve. We heard from him this week. We heard from the FOMC. How do you react to what you heard and saw?
We're lucky to have Jay there, and I think in the fullness of it all, he's made very good judgments. I think that they need to be more mindful of the possibility that the conventional wisdom is wrong and that we have a little more inflation picking up a little sooner, or that financial markets get away from us. And so I thought he was so focused on providing reassurance on the Fed's continued stimulus to the economy that he created a dynamic where if it was necessary to do things the other way, it would come as a pretty jarring shock. And that was my worry about how he calibrated the balance. But all things considered, I'm glad he's there.
Larry, it's always such a pleasure to deal with you every single week. That is special Wall Street Week contributor Larry Summers of Harvard. Finally, one more thought. The vaccination site, 800 years in the making. As we press forward urgently, impatiently, to get as many people vaccinated as soon as possible, we face a series of hurdles. Manufacturing doses as fast as we can, testing and approving new vaccines, getting the medicine distributed, covering the last mile, and getting it into people's arms.
Only vaccinating everybody everywhere would get us out of the risk of this mutation.
But of all the problems we face, real estate isn't really one of them. Google the term mass vaccination sites, and you get almost 1.5 million results. Everything from pharmacies to hospitals to sports arenas.
We hope to open up in roughly about 2 weeks' time the BOA Center for mass vaccination centers.
But there's only one that has the highest spire in all of England, the largest cathedral closed, the largest cloister, and that is the Cathedral of Salisbury, where, according to legend at least, back in about 1220 or so, a bishop shot an arrow into the air, hit a deer, and where the deer fell is where they built the cathedral. And that cathedral now is a mass vaccination site. And now the chapel of St. Michael the Archangel is filled with refrigerators for the vaccine. The huge nave is full of chairs rather than pews. And that's where the elderly who have been inoculated wait to make sure they have no allergic reaction. Wait while 2 church organists play soothing music while they wait. You can call it sang-froid, you can call it a stiff upper lip, but as we all wait for the vaccine we believe will save us, leave it to the Brits to do it with class. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.